Well, it's truly an honor to have this opportunity to introduce David Hirshleifer for his presidential address. After receiving his PhD from the University of Chicago, he's held positions at the Anderson School at UCLA, University of Michigan, Ohio State, and he's now the Distinguished Professor of Finance and Economics at the Mirage School of Business at UC Irvine. David lists, and I quote, psychology, social interactions, and markets as his primary areas of research. And in perusing his vita, one can't help but be enormously impressed, indeed maybe even a bit overwhelmed by the depth and breadth of the research he's done on these themes. I went back to his vita and some of his papers and reread them as I sort of prepared these opening remarks, and started with a theory of fads, fashion, custom, and cultural change as informational cascades, which is written with Bikhchandani and Welch back in '92 in the JPE. It's become his most widely cited paper, and it has an amazing uniform distribution of citations over the decades. It's a truly insightful explanation of how small shocks can lead to informational cascades, and I think equally importantly and interesting, why such cascades can be fragile. Equally central to his research agenda has been his striving for a rigorous understanding of the behavioral underpinnings of the short and long-term autocorrelation structures of stock returns, and indeed the differences between short-term patterns versus long-term patterns. He took this up in a paper, again, some time ago, on investor psychology and security market under and overreactions with Daniel and Subramanian in the Journal of Finance. It also continues to get, not surprisingly, but very steady citations over the many years. And if you look at his research over the years, you see him coming back to these themes off and on, and indeed he's returned to this second theme quite recently in his work on behavioral factors underlying excess returns in stock portfolios. Now, these tremendous accomplishments are grounded in an impressive pedigree that I've come to understand and learn much more about over the last few weeks. Something I did not know until recently, though I think many of us who have been working with David closely over the last several years sort of intuitively felt, is that he grew up in the high fashion business. And for those of you in this room who hear the name Hirshleifer, I suspect the vast majority of you, like me, think microeconomics or behavioral finance. But if you step outside this room, and for those of you who read the magazine GQ or happen to subscribe to Gwyneth Paltrow's Twitter feed, you will see that Hirshleifer's is the go-to place for high fashion, especially in the New York area. And they would recommend that you check that out next time you're in the area. Now, in addition to this, he has a very deep artistic side, and this is also actually inherited from his family. I didn't find this by Google searching, but I got able to get access to a copy. Many of you probably have not. His poem on the lira, quite moving, although there are probably other political reasons why it hasn't reached the same level of recognition as other people writing about the lira recently. He's a serious pianist, he's a composer. I guess if I had known that, we would have a piano at the reception afterwards. I didn't get that planned, my apology for that. But recognizing all of these dimensions at once, I think it helped me come to kind of a deeper and better understanding of his accomplishments. His research on behavioral issues is grounded in psychological evidence on how people actually behave. And indeed, I can't help but imagine that the seeds for this weren't planted as you were growing up in the fashion industry and were looking at behavioral patterns in that industry. And if you've read his work, and I'm sure many of you have, you see that he composes theories that give rise to truly elegant and novel over-identifying restrictions. And equally importantly, his theories speak to a wide range of anomalies, giving them depth, credibility, and persuasiveness. So when I think about all this work and the breadth of the so many issues that he's looked at, I'm actually quite curious, and I'm not going to speculate or guess as to what he's going to talk about, but I am going to turn the floor over to David, and we can hear the presidential address. So David?
Thank you so much. Thank you so much, Ken, for the excessively kind words, which I really appreciate. And speaking as president of the AFA for just a few more minutes, I want to say that the AFA does not make formal endorsements of any fashion vendors. I want to talk, for any of you who are standing, I see roughly at least 20 empty seats in the front rows, so feel absolutely free to come right up and grab a seat if you'd like. And let's see, and also these slides and a transcript of the talk will be available on the web by tomorrow. I'd like to talk to you about an intellectual revolution, which I call social economics and finance. A missing chapter in our understanding of finance is the social processes that affect economic thinking and behavior. Social and economic finance is the study of how social interaction affects economic outcomes. It recognizes that people observe each other and talk to each other, where talking includes textual communication. A key underexploited intellectual building block of this field is what I call social transmission bias, which is just that ideas or signals get modified and systematically transformed as they pass from one person to another. So by way of comparison, some recent intellectual revolutions include information economics, which recognizes that some people know things that others don't, and behavioral finance, which recognizes that people make systematic mistakes. So, of course, scholars already knew these rather obvious facts before each intellectual revolution. But the problem was that these were considered informally or sporadically. So they were not systematically, explicitly, and routinely incorporated into our models and into developing test hypotheses. So for social economics and finance as well, we're only just starting to systematically incorporate this into our intellectual toolkit. In behavioral finance, for example, our path from assumptions to conclusions is often very direct. When we see investors trade too aggressively, they must be overconfident. We see investor expectations rising more after price run-ups and down after price rundowns. Investors must over-extrapolate. For preferences, there's evidence that investors buy lottery stocks, sell winners more than losers, save too little. Well, we have behavioral models where people have preferences for each of these things. And I'm a big fan of these direct approaches. I think they capture a very large part of the truth. However, turning off the screen is not the right answer. Importantly, attraction to a behavior is not the same as a preference for it. So for example, moths are attracted to flame, to light bulbs. However, moths don't have a preference for flying into flames. There's no reward system in the brains of moths which generates higher payoff the closer they get to a light bulb. Instead, moths evolved under natural selection, and their navigation systems evolved to work well with a distant light source, the moon. And the problem is that this navigation system gets systematically fooled when moths are faced with a nearby light source, such as a light bulb, leading to a dysfunctional outcome of approaching the light bulb. So moths are not not flame-loving. And indeed, this is an indirect outcome. So it's not that they directly like bulbs, but that indirectly this behavior emerges. And another kind of indirect emergence of behavior is social emergence, where in a population of individuals, the aggregate outcome is not just the sum of the individual propensities. For example, death spirals among army ants. So ants will occasionally get stuck in death spirals where they will continue walking for days until they die. And these are sometimes hundreds of feet wide. So, of course, ants are very small-brained creatures. This couldn't possibly happen to a smart kind of animal, such as a mammal, for instance. Except for man's best friend. Of course, this is just an outlier example. Oh, wait a second. Okay, well, this has happened more than once, but dogs are kind of dumb, right? Birds are smart. Well, this is the most disturbing scene of all. These turkeys are marching around the body of a dead cat in some kind of religious ritual. So, an implication of such social emergence is that it's unwarranted to go from an observed behavior to a direct psychological bias for that behavior. But in the finance field, such emergent social effects are usually neglected. And the reason for that is that we usually don't think about social interactions, and social transmission bias is missing from our standard toolkit. So the goal of social economics and finance is to start out with standard ingredients and build on a firm base of preferences, optimization, equilibrium, and in assuming psychological biases to try to motivate assumptions well based on psychological evidence and evolutionary plausibility, and then to use these ingredients to try to capture systematically and tractably socially emergent effects, not just direct effects. So in the rest of the talk, the heart of the talk is going to be 5 fables or models of social transmission bias in economics and finance. And this is work by my co-authors and myself, where I'll try to persuade you that social transmission bias may have some novel messages to offer and may be wide-ranging in scope. I'll start with some milestones of the social economics and finance revolution. And clearly, the amount of important pioneering work is too great, too extensive for me to cover tonight. But again, these slides are going to be available on the web. In fact, going forward, let me turn to a little more on what is social transmission bias. So first, social transmission is where signals or ideas get passed on from person to person and behaviors. Social transmission bias is where these signals or ideas get systematically modified in the transfer from a sender or from a target of observation to a receiver or an observer. And so this means that transmission bias derives from both senders and receivers, from their incentives or from their psychological biases. Now, fortunately, in the social economics and finance field, there's been recently extensive attention to a crucial building block, social networks. But I'll argue that there's another crucial building block, social transmission bias, which has been relatively underexplored. So social transmission bias can take the form of signal distortion. So that means a shift in the sign or intensity of what is transmitted. So for example, the owner of a stock may talk up the stock to try to persuade people to buy the stock. And listeners may fail to discount for this bias, which is another aspect, another ingredient of the social transmission bias. A second aspect or form of social transmission bias is selection bias. that is bias in whether something is transmitted. An example of this is self-enhancing transmission bias. So investors like to talk about their trades or their strategies where they made money more than when they lost money. And there's evidence for that kind of difference. And again, listeners may fail to adjust for that fact. So now we'll turn to 5 fables or models of social transmission bias in economics and finance. The first is about bandwidth constraints and simplistic thinking. This is co-authored with Omer Tammuz. So suppose that when we communicate ideas that there's some loss of nuance. So you can think of political sound bites on TV, for example. Now, a crucial reason for such loss of nuance is that there are bandwidth constraints. And so these are time constraints. We can think of Twitter character limits on Twitter, and also cognitive constraints, because it's hard work to convey ideas with nuance and for listeners to understand the nuances that are being communicated. So suppose that receivers think that senders have useful private information, but that receivers fail to adjust for the loss of nuance in the transmission process. Well, in that case, receivers are going to tend to infer that senders have rather simple or extreme beliefs. And that will induce the receivers to adopt beliefs that actually are oversimplified. Furthermore, as people talk to each other repeatedly, this can be iterated, leading to iterated loss of nuance. So the overall outcome, society can evolve toward extreme simplistic thinking. And indeed, it can even lead to judgments made by people that are worse than they would have made if they hadn't talked to each other at all. Given how society has been moving today, I'll leave to you whether this is a realistic prediction or not. Fable 2 is about self-enhancing transmission bias. And this is co-authored with Bing Han and Yuhan Walden. So suppose there are 2 strategies, A for active and P for passive, where A can refer to either higher variance or higher skewness of the investment strategy. So over time, investors of type A or type P are randomly selected to meet, at which point one randomly becomes the sender and has some probability of reporting her profit experience to the receiver, where high returns are more likely to be reported than low returns. So the receivers have a couple of standard behavioral biases. They fail to adjust for the selection bias in what they hear about, and they think that past performance is indicative of future performance. So because of this upward selection bias in the return reports, it turns out that investors get attracted to the high variance strategy over the low variance strategy. So in this diagram, you can see the high variance strategy generates a larger upper tail of higher returns. And these are the returns that are heavily reported as compared to the low variance strategy. So that makes the high variance strategy persuasive and attractive more often. And so the P investors tend to become converted to the A strategy. That prediction is consistent with some facts about investor behavior, such as inadequate diversification, and also with several return anomalies. There's also empirical support for this mechanism. Now let's think about a variation, which is that suppose that extreme returns, either high or low, are more salient and noticeable to receivers. Well, I won't go into why, or let me say, suppose also that receivers are not going to convert to the strategy of the sender unless they're paying attention. So I won't tell you why, but it turns out with that assumption that positive skewness strategies also tend to spread. So lessons from this, there's an attraction of investors to variance and skewness. Investors don't like variance or skewness per se. They don't have any preference for it. Nor do they have any belief, I think high variance stocks are going to outperform. Indeed, investors may be unaware of the variance or skewness of alternative strategies. Instead, this attraction to these strategies is socially emergent. So just as ants as individuals don't tend to walk in circles, but in groups they sometimes do, similarly investors don't have any individual tendency to attraction to variance and skewness, but in groups they do. And this social emergence implies distinctive empirical implications. For example, that investor behavior is influenced by personality traits that affect transmission bias, that there's an effect of the investor's position in the social network, and that aggregate outcomes depend on the connectivity of the social network. The third fable is about visibility bias and overconsumption. So this is with the same co-authors. And visibility bias, in our context, is the fact that engaging in a consumption activity is often much more visible to others than refraining from doing so. So for example, when the first Starbucks opened in a city in China, it was very visible to others that a lot of people were willing to pay a lot for a cup of coffee instead of drinking cheaply at home. Wearable electronics are another example where consumption is highly visible to others. So suppose, in our model, observers don't adjust for this bias in what they observe, that they disproportionately observe consumption. And so they infer that others are consuming heavily. Suppose now that X is how much people need to save for the future. It could be, for example, the probability of getting laid off and experiencing a wealth disaster. X is the same for everyone, but there's uncertainty about its exact value. And different people have different information about the value of X. So potentially there's an opportunity to learn from observing the actions of others. So because of this visibility bias, people mistakenly learn from what they think is the high consumption of others that X is low, that there's little need to save. And in consequence, they save very little. They overconsume. Furthermore, there's a positive feedback here, because now people really are consuming a lot, and then the visibility bias gets piled on top of that. So people are heavily consuming, and that high consumption is a target for observation of others. So that means that overconsumption can get relatively extreme. This has some non-obvious consequences, and one that I'll mention is that wealth dispersion is the effect of wealth dispersion, and in particular information asymmetry, that people don't know the exact wealth of the people they're observing. So that turns out to weaken these effects, and that's the exact opposite of wealth signaling models. So models where people consume heavily to show off and to try to prove that they're wealthy. Because in those models, it's information asymmetry about wealth that's the exact driver of consuming heavily. So the moral of the fable, or the story here, is that there's no direct bias for overconsumption. So that contrasts with behavioral finance and with the important theory of present bias preferences, where people are basically tempted to overconsume because of their preferences. So why should we care about this difference between the theories? Well, they have very different empirical and policy implications. So in the social transmission bias theory, people have mistaken beliefs. And in consequence, accurate disclosure can correct these mistakes. They can help improve social welfare. And furthermore, since the theory is about social interactions rather than just an individual preference, that means that targeting policy implications by individuals' positions in the social network can be more effective in improving things. So that means that it's vital for good policy to have empirical testing between different approaches. And as it turns out, there's empirical support for both mechanisms. The fourth fable is my main model of the evening on biased information percolation, action booms, and price bubbles. So one of the purposes of this model is to try to capture the beyond all reason feature of market booms or price bubbles. So things like religious awakenings or enthusiasm for Bitcoin sometimes goes to extremes. So in the model, there's a continuum of agents, and each agent takes some action with an intensity theta in continuous time for agent I at continuous state S. So this could be adopting an innovation with some intensity or buying a stock, for example. There's some random payoff X per unit of the activity, and the payoff is realized at the terminal date T. Agents are each endowed with one private signal about the value of the fundamental X, and distributions of the signals and the fundamental are normal. So looking at the timeline, at the start date, we have the private signals that each investor I is endowed with, and at the terminal date, we have the terminal payoff. And then at each discrete date, 1, 2, 3, and so on, public signals arrive. So we can think of these as quarterly earnings announcements, for example, arriving in sequence. And then at the bottom with trading is occurring in continuous time. So these up arrows are pointing to the many dates at which trading is occurring. And on the top, investors are randomly meeting with each other socially, where in those meetings they share signals with each other. And those are also happening at many dates in continuous time. So models where people are randomly selected to meet and share all their signals and continuously, there's fascinating work on this, on information percolation by previous authors. And so in these models, when agents meet, they share their accumulated signals, but in equivalent modeling, you could view these as bloggers who are randomly seeing each other's postings in continuous time. So past work on information percolation has derived conditions under which the number of signals per person, the number of private signals grows exponentially over time. And so this phi here is the number of signals per person, and we have exponential growth. I introduced two key transmission biases to this model, but I'll focus on just one of these, which I call B bias. And so B bias is that in each meeting, a bias of B is just added to the average signal that the sender reports to the receiver. So there's reason to think that B could be either positive or negative. So there's an empirical literature on information transmission, which finds that senders tend to transmit positively. And there are some reasons for this. For example, this can help senders be perceived as being useful by receivers. For example, it's much more helpful to learn about what product I should buy than about the 100 products that are not as good that I shouldn't buy. And there's also reason to think that B might be negative. So on the receiver side, psychologists have extensively studied negativity bias, which is a tendency for people to especially pay attention to negative information or to interpret information that they see negatively. And there are some evolutionary underpinnings for the negativity bias. So with B bias, with B getting added to the average signal each meeting, well, meetings are occurring repeatedly again and again, and so this B bias gets recursively amplified and can become very large. Indeed, even if B is approximately 0, if this goes on long enough, there can be very large biases that follow. And on the other hand, if B is very close to 0, it may be quite a natural mistake for people as a heuristic to just ignore B, to use the heuristic that B is 0. So that kind of heuristic in general of treating something that's very small, ignoring something that's very small, in many aspects of life, that's a very reasonable heuristic that works really well. But the problem is that in a scenario with social amplification, it can work really badly. So in the model, people have mean variance preferences, And they make myopic decisions at each continuous date. So they act as if this was the last decision they were ever going to make. There are two versions of the model, and I'll just briefly mention the action booms model, where the aggregate action is endogenous. So for political activism, in total, we can be as active as we want as long as we're willing to pay the cost. But my focus tonight is on the price bubbles model, where the action is buying a single risky security, and where the aggregate supply of that security is exogenous. So that means that the aggregate action or aggregate purchases of the security are exogenous. And in particular, I'll assume a stochastic price shock theta as a standard in securities markets models, so that price is determined endogenously, and I allow for investors learning about the private signals of others through price. So here's a graph of a smooth graph of the expected price of the security over time. So on the vertical axis, this V sub S is the price at date S, and we have that expected value given the transmission bias B. This is the graph where the transmission bias is positive, which leads to a hump shape, and when the transmission bias is negative, there's a mirror reflection U shape going under the x-axis. And so you can see that the process on average starts out slowly, and then the price grows more and more quickly, although eventually it corrects. So for a time, there's convexity in the expected price path. And the reason for that is there's multiplicative growth in the effects of bias. And the reason that's happening, well, this bias is coming from information signals, and the number of signals per person is growing exponentially. So an exponential curve is already convex, leading to convex updating over time. But in addition, we have this recursive amplification of the bias, so that the bias per signal that investors have is on average increasing as well. And so that multiplicatively further exaggerates the convex growth path. On the other hand, eventually there's also correction. So in the model, public news is arriving with greater and greater precision, and as a result, the bubble eventually corrects, so that we end up with this hump shape or the U shape. Empirically, this prediction that the expected price starts growing slowly and accelerates is consistent with some evidence about actual price bubbles. Notice that I'm getting a price bubble without the usual behavioral finance ingredients, such as overconfidence or overextrapolation. Furthermore, there's predictability of investor expectations and stock returns in the model. So this smooth expected price path, this hump shape or U shape, is similar to some behavioral models that have impulse response functions with those shapes, and which therefore generate momentum or reversal in stock returns. Furthermore, beliefs are becoming more optimistic as you run up and becoming less optimistic as you run down. And so this tendency for beliefs to be related to past returns also has some supporting evidence. But notice here that this is an emergent effect. It's coming from the accumulation of transmission bias. So in the model, high returns are not causing over-optimism. This is not a causal effect. There's no extrapolation of returns by investors. So this is one more example of an emergent effect, that just as ants are not trying to walk in circles, similarly, investors are not extrapolating, but you get something that looks like extrapolative beliefs. Also in the model, disagreement rises and falls with the bubble as well. The model also implies predictability based on public news events, both predictability on the news dates and post-event drift, consistent with some stylized facts. And so in the model, this can be seen from the Stegosaurus graph, which is the bright blue jagged graph of the actual expected price path instead of the smooth expected price path. And so these discrete drops that you see are on public news events. So for this positive bubble here, the stock is overpriced on average, and on average on each public news event there's correction, so that you get predictable drops on public news arrival dates. And furthermore, investors tend to be too stubborn in believing in their B-bias effects, and that leads to post-event predictability as well. Furthermore, if you look at this up-down zigzag, it's highly suggestive of short-term reversal. So there's some hope in this model that there might be an implication under some parameters of short-term reversal effects. And if so, the model has the potential to deliver greater unification of return serial correlation anomalies of long-term reversal, yet medium-term momentum, and yet possibly short-term reversal as well, if the frequency of arrival of public news events is high enough to compare with the stylized facts. In addition, notice that the oscillations become very jagged near the peak. I call this phenomenon peak oscillation, and this is another empirical prediction of the model. Stepping back, I should mention, by the way, the predictability on the public news event date. If this were a negative bubble, then these would be jumps on average in price instead of drops on average in price. So peak oscillation, intuitively what's going on is that, what does it mean for the bubble to be rising? Well, it means that the upward and accelerating pull on price of bias percolation is outweighing the corrective effect of public news arrival. And so to be in the upward phase of the bubble means exactly that these downward jumps are relatively small. And so we have this relatively smooth price path moving up the bubble. And then what does it mean for the price path to peak? Well, it means that with this now very large bias percolation pulling up prices very rapidly, to prevent that to nevertheless reach a peak, that means that the public news corrections need to be very powerful. And so that means that to reach a peak means that there are very large zigzags. But eventually, as a great deal of public information arrives, it becomes relatively conclusive so that the bias percolation is not able to pull the price up as much. And so then these zigzags start to be damped, and you get damped oscillations. So you have this tug-of-war between bias percolation and public news arrival. Before the peak, percolation wins. Near the peak, you have peak instability, and then the damped oscillations provide a possible justification for the Wall Street saying of dead cat bounce. So the last fable is on bias transmission of folk models. So a folk model is an understanding of how the world works. For example, belief in heaven and hell, or in the payback criterion. Since after all, hell is a kind of payback. So folk models, I didn't have to explain that joke, I'm glad. So folk models spread from person to person, and distinguished scholars have argued that these are crucial drivers of human behavior. They're often shaped by vivid narratives, but they're also often relatively mundane beliefs as well. An example of competing folk models is the idea that returns tend to continue, as in the trend is your friend, and the contrarian idea that returns tend to reverse, as in the recommendation buy on the dips. Behavioral finance takes this extrapolation or contrarian belief as given. Social finance says, wait, these might be endogenous, that sometimes these might spread contagiously. So it's been proposed by several authors that to model this kind of contagious spread of folk models or beliefs, that compartmental models from epidemiology are ideal for this purpose. So these models These models analyze the spread of infection by looking at random meetings that are occurring between individuals in the population that spread an infection. And one such compartmental model is the SIR, or SIR model, which is one of the models that leads to an epidemic rise and fall path of the epidemic, which is reminiscent of market bubbles, or booms and busts. So we can see that in the red graph here, where you can see a convex growth to a peak, and then eventually there's recovery from the infection, and so the epidemic subsides. You can also see that this is convex, so there's a self-feeding effect going on in the SIR model, that it starts slowly and for a while it accelerates. I won't go into why. But in the SIR model, there are three types in the population: S for susceptible, I for infected, and R for resistant, recovered, or removed. So at the start, almost everyone starts as a susceptible, and in a meeting, a susceptible who meets an I can randomly get infected. The probability that that happens is a measure of transmission bias toward the infection. And there's also random recovery over time, where an infected becomes recovered. So how would we adapt the compartmental approach to better fit the transmission of folk models and its effect on economic behaviors? Well, one very simple thought is that infected could mean that you have a folk model that makes you over-optimistic. So you can become infected with enthusiasm for Bitcoin, for example, and overestimate the expected payoff of the asset. Three other thoughts about how to vary the SIR model. One is simply to add an S at the end, and to allow that a recovered might spontaneously become susceptible again. That just leads to the standard SIRS model, and I won't go into why I think that that's helpful. A second ingredient is to add an asset market, much like Fable 4. But third, and perhaps more interesting, is to introduce buzz into the model. So this is the idea that when there's growing excitement about a folk model in the population, that can make meetings more contagious. So, for example, when Bitcoin becomes hot, so that people are rapidly adopting Bitcoin, a lot of people are hearing about Bitcoin, and that might mean that when someone has a meeting with a Bitcoin enthusiast, that meeting is more contagious. So I modeled that as a transmission bias toward infection that's increasing in what I call buzz, where buzz is just the time derivative of the fraction of the population which is infected. By the same token, there can be negative buzz, where if Bitcoin is getting cold and everyone knows that a lot of people are losing enthusiasm for it, then maybe meetings can start triggering recovery from the folk model. So when a Bitcoin enthusiast meets a skeptic, maybe the enthusiast is the one who gets persuaded to lose interest in Bitcoin. So this is in sharp contrast to epidemiological disease models, which are one way, that meetings only spread the disease, they never cure the disease. So the effect of buzz is to exaggerate booms on the way up and exaggerate collapse on the way down. So it intensifies the self-reinforcing feature of bubbles. So here's the price path, or a price path in the model with buzz. So V sub S here is the price at date S, and you can see an accelerating growth pattern, so a big bubble which corrects. But notably, the bubble overcorrects, and so you get an overshooting where the bubble corrects down too much and then moves up, and so you have this damped oscillations pattern. And what's going on here is that the fraction of infecteds goes up very high until there are very few susceptibles left in the population. Now people start recovering extensively, and with few susceptibles, it's hard to get many new infections. And so the fraction of the population that's infected overcorrects, so that the fraction that's infected goes down to below the long-term fraction, the long-term equilibrium fraction for the population. So then that fraction needs to correct upward, but it overreacts upward as well, and so you get the damped oscillations. This kind of damped oscillation pattern is potentially consistent with a rich set of autocorrelation patterns in stock returns. I'd like to sum up with some emergent themes about social economics and finance. The first is compounding, that social transmission bias compounds recursively. So in consequence, even a very small transmission bias can eventually have very large effects. Second is that social transmission bias helps explain the idiosyncrasy of aggregate outcomes. That is, the fact that they are error-prone, that it's unpredictable, it's hard to predict bubbles. And this is a consequence of theme one, sensitivity to small biases, as well as sensitivity to the environmental shocks that may interact with those biases. Third, social transmission bias offers an endogenous social explanation for action booms, price bubbles, swings in investor sentiment, and it does so without standard behavioral finance, or it can do so without standard behavioral ingredients for bubbles. That is, it still has behavioral or psychological ingredients, but not the same ones we usually use to derive bubbles directly. Third is emergence. Socially emergent behavior often looks completely different from individual propensities. So individual ants don't walk in circles. Self-enhancing transmission bias doesn't look particularly similar at the individual level to liking volatility. If you had just one investor, you don't get overconsumption in our model, but when you put them in a socially interacting group, overconsumption emerges, and so forth. Fifth is that social emergence can easily create the illusion of a direct behavioral bias for something, for a behavior, when no such bias exists. So in the models I've mentioned, there seem to be lottery preferences, even though in the models there is no such preference. There seems to be present bias in consumption when there is none. There seem to be extrapolative beliefs when there is none in the model. And that means that we are routinely overstating our inferences in empirical tests because we are forgetting about alternative social hypotheses. And that's because we are missing social interaction and social transmission bias from our toolkit. And sixth and last is that the social approach in general and the social transmission bias approach suggest a rich set of new test variables to consider. And this includes both general proxies for social interaction, as well as more specific proxies for the sources of transmission bias, both on the part of senders and receivers. So in closing, we academics sometimes get caught in closed loops. At worst, these become ritualistic cycles, and even at best, they act as blinders that close us off from part of reality. But humans are smarter than turkeys, even though it doesn't always seem that way. And we can break out of our closed loops. And when we do break out of our closed loops, it's very exciting. I believe that social economics and finance is a once-in-a-generation research opportunity. The poet John Keats, when he experienced a life-changing revelation, said that he felt like the watcher of the sky, like some watcher of the skies when a new planet swims into his ken. Like that astronomer, I think that there's a world of opportunities now for us to explore and to better learn about human behavior in markets and in general. The outline of a new field of inquiry is now discernible: social economics and finance, and some of its key building blocks: social networks, folk models, and what I've emphasized tonight, social transmission bias. Thank you.
Thank you, David, for that very stimulating talk. So I have the pleasure now of presenting David with two items. The first is a plaque recognizing all of his contributions as president of the American Finance Association, and I can attest firsthand that they have been enormous. It's been an extremely busy year for all of us, but especially for David. And so thank you very much.
Thanks so much, Ken.
And the final honor I have is that now that David is transitioning out of being president of the American Finance Association, among other things, besides transitioning back to his life, he becomes a fellow of the American Finance Association. So I would like to present this appreciation for that and congratulations. And
Booze, I trust.
exactly. Welcome as a
again.
fellow.
Thank you.
So, thank you very much.
Okay, and I now have the great honor of passing the Ring of Power to the new president of the American Finance Association, Ken Singleton.
And my sole responsibility at this stage is to thank you all for coming this evening, to call this meeting to a close, and to invite you all to participate in the reception outside the room here. So I hope you enjoy the rest of the meeting.